Let me ask you something. When the Federal Reserve makes a decision about interest rates, do you feel like that affects you? Do you feel like that's something you need to pay attention to? Most people say yes, but then I ask them, do you understand how it actually works? What's the mechanism? What's the chain of events between a meeting in Washington and the number on your mortgage statement? And most people go quiet. Here's the thing. There is a market that controls your mortgage rate, your car loan rate, your savings account yield, and if you follow crypto, the price of Bitcoin. It moves every single day. It's the largest financial market in the world, bigger than the stock market by a factor of 3. And most people have never thought seriously about it for a single day in their lives. It's the bond market. And today I'm going to explain it to you in a way that actually makes sense, not the textbook version, not the Wikipedia version, but a version that explains why your rent went up, why your mortgage costs what it does, and what you should be watching every single week if you want to understand where your money is going. My name is Yeng and I cover crypto, investing, and personal finance. The bond market is something I cover constantly because it drives everything from treasury yields to crypto market cycles. And it's criminally underexplained in plain language. Hit subscribe and give this a thumbs up if this helps. Let's start with the simplest possible explanation of what a bond actually is. A bond is a loan. That's it. When the US government needs money, and right now it needs a lot of it, it doesn't just print it. It borrows it from investors. It sells a piece of paper that says, lend us $1,000 today. In 10 years, we'll give you your $1,000 back. And in between, every 6 months, we'll pay you interest. The interest rate on that loan right now in July 2026 is approximately 4.55% to 4.56% per year for a 10-year Treasury note. You lend the government $1,000, you receive $45.50 per year in interest. 10 years later, you get your $1,000 back. $1,000 lent to the US government for 10 years earns you $455 in total interest. Government guaranteed, zero credit risk. The only risk is inflation eating into the real value of that return. Now, every single one of these yields changes every day. They're set by the market, by what investors are willing to accept in exchange for lending money to the government. And the direction of that yield, up or down, is the most important single data point in all of global finance. Here's why. There's a phrase that one of the best mortgage rate analysts in the country uses to explain the bond market's power. It says, Treasury yields are gravity. Other forces can move around them, but they can't escape them. Here's what that means in practice. The average 30-year mortgage rate right now is 6.50%. The 10-year Treasury yield is 4.55%. The difference between those numbers, 1.95 percentage points, which is called the spread. Mortgage lenders look at a 10-year Treasury yield and say, that's the risk-free rate. The government will definitely pay us back. A homeowner might not, so we need a Treasury yield plus some premium to justify the risk. That premium is the spread. Historically, that spread runs between 1.5 and 2.0 percentage points. During the 2023 to 2024 rate shock, it widened to nearly 3 points, making mortgages even more expensive than the Treasury rate alone would suggest. When the 10-year Treasury yield goes up, your mortgage rate goes up. When it goes down, your mortgage rate goes down. The Federal Reserve gets all the credit and all the blame, but the 10-year Treasury is the actual mechanism. Look at this chart. In early 2021, the 10-year Treasury yield was around 1%. Today, it's over 4.55%. That 3.5 percentage point rise in the bond yield is the entire explanation for why mortgage rates went from 3% to 6.5% over the same period. Not the Fed, not the inflation alone, not a single political decision. Bonds. Here's the concept that trips people up the most, and once you understand it, you'll see financial news completely differently. Bond prices and bond yields move in opposite directions, always. This is not a preference or a trend, it's a mathematical relationship baked into how bonds work. Let me make it real with a simple example. You buy a bond for $1,000 that pays $45 per year in interest. That's a 4.5% yield. Now, imagine the bond market panics, investors want out, they start selling bonds, the price falls to $900. But the bond still pays the same $45 per year. That doesn't change, that's the coupon, it's fixed. At a $900 price, the same $45 payment is now a 5% yield. The price went down, the yield went up. This is why when investors panic and dump bonds, yields spike, and when yields spike, mortgage rates spike. And when mortgage rates spike, the housing market freezes. It all allows from one relationship, price and yield move in opposite directions. Right now, in July 2026, we are in exactly this environment. Geopolitical tension from the conflict in Iran drove up energy prices, which drove up inflation expectations, which drove investors to demand higher yields on bonds, which pushed the 10-year Treasury to 4.55%, which is keeping mortgage rates at 6.50%. That chain of events, from a war in the Middle East to the rate on your home loan, runs entirely through the bond market. Alright, this is the section most YouTube bond videos skip, and it's the one that's most directly relevant to what this channel covers. Here's what most people don't realize. Bitcoin and the bond market are deeply connected. Not because Bitcoin is a bond, because bonds set the opportunity cost of everything else. Here's the mechanism. When the 10-year Treasury pays 4.55% with zero risk, every other investment has to compete with that. When the 10-year Treasury was paying 1% in 2020 and 2021, investors had almost no alternative to risk assets. Stocks, crypto, real estate, everything went up because sitting in bonds paid almost nothing. When the 10-year rose to 4%, 4.5%, and 5%, suddenly, doing nothing earned you 4 to 5% guaranteed. The appeal of volatile assets dropped. Institutional money rotated out of crypto into treasuries. Bitcoin fell 65% from its 2021 peak during the same period that the 10-year yield was rising. This isn't speculation. This is a documented, observable correlation. When bond yields are high, crypto faces a strong headwind because the alternative, the guaranteed government yield, is genuinely compelling. When bond yields fall, the headwind eases and risk appetite returns. If you want to understand when the next crypto bull run is coming, watch the 10-year Treasury yield. When it starts trending meaningfully lower, that's when money flows back toward risk assets, including Bitcoin. Okay, 3 practical things you can do with everything we've covered. Number 1, bookmark the 10-year Treasury yield and check it weekly. You don't need to check it every day, but once a week. Glance at the 10-year yield. If it's rising, expect mortgage rates to hold high or go higher. And expect headwinds for crypto. If it's falling, the opposite conditions are developing. Number 2, if you have over $1,000 in savings you don't need for 6 to 12 months, consider TreasuryDirect. At 4.3 to 4.4% APY, short-term Treasury bills are offering genuinely attractive risk-free returns right now. You can buy directly from the government with a minimum of $100, no fees, and no broker. This is not a long-term investment strategy. It's a place to park cash that's waiting to be deployed while also earning a return that beats most high-yield savings accounts. Number 3, use bond yield direction as a crypto timing signal, not a guarantee. When the 10-year Treasury yield was at 1% in 2020, Bitcoin ran from $10,000 to $69,000 per token. When it rose to 5% in 2023, Bitcoin was under significant pressure. This is not a perfect correlation, it's not the only factor, but bond yields are the macro environment that risk assets operate inside. Understanding that environment doesn't tell you when to buy. It tells you whether you're swimming with or against the current. Here's the honest summary. Bonds are loans. The interest rate on those loans, the yield, moves every single day. When the 10-year Treasury yield goes up, mortgage rates go up, borrowing gets more expensive, and risk assets like crypto face headwinds. When it goes down, the opposite happens. The mechanism is the inverse relationship between bond prices and yields. When prices fall, yields rise. And yields are the gravity that every other asset in the financial system orbits. Right now, in July 2026, the 10-year Treasury yield is 4.55% to 4.56%, and mortgage rates are 6.50%. That spread and the inflation pressure from the Iran conflict keeping bond yields elevated is the story of why your mortgage costs what it does, why crypto is under pressure, and why the Fed's decisions take so long to actually reach your wallet. You now understand the mechanism, and understanding the mechanism is how you stop being surprised by financial news and start reading it before it affects you. If this gave you a framework that actually makes sense, please hit the like button. It helps more people find this content. Subscribe and hit the bell. I post every week on crypto, investing, and personal finance, including the macro connections most creators don't cover. Drop a comment below. Before this video, did you understand how bond yields connected to your mortgage rate? And what's the one thing you'll track differently now? I read every single comment. See you in the next video. Bye!